Hello and good afternoon, and welcome to our webinar focusing today on investing in private equity. We're lucky to be joined first by Paul Daggett from Neuberger Berman, who's speaking to us from the US, and Alan Gould from Aberdeen Standard, who joins us from Edinburgh. A bit of housekeeping first. I'll be giving a brief overview of the listed private equity sector. Then we'll have around 20 minutes for the two experts in the field each, before leaving plenty of time for questions at the end. If you can submit these using the Q&A function at the bottom right-hand side of the screen, I'll do my best to cover them and put them to the correct manager, or both if appropriate. So first of all, investing in private equity. So what is private equity investment? This is primarily investing into unlisted businesses, which are majority owned and controlled by the manager or sponsor, as it's known. And these are long-term investments, mainly because they're illiquid. The management teams are highly active, and they often roll their sleeves up, getting involved in everything from the strategy to the financing of these businesses. The objective is usually capital growth, with value crystallized when an exit is made. And an important distinction to be made is that private equity is not growth capital or venture capital, typically. Scottish Mortgage makes minority investments in private or unlisted investments. And typically, a lot of these investments are at an earlier stage and less mature than the companies that that private equity investors are buying. So the listed private equity sector overview. So what I've done here is I've grouped the London listed private equity sector into how they make their investments. So on the left-hand side, the direct investors, which is 3i Group, is the largest and arguably the best known. It constitutes about half the assets of the entire sector. So these are quite concentrated portfolios. And then on the right-hand side, the diversified fund of funds, which are very diversified. They have over 1,000 underlying holdings. And then in the middle, you've got NB Private Equity Partners and Standard Life Private Equity, which represent diversified but not overly diversified portfolios, and I'm sure the managers will explain the differences between them later. So the listed private equity sector in some ways divides opinion. Certainly Chris Brown, who's an analyst at JP Morgan Cazenove, said recently, it continues to stagger us that stocks like this are trading on such big discounts. And what he was talking about really is their performance during 2020 and the fact that the discounts really are quite wide. But then again, as my compliance team insisted on me putting on the other side of the coin, is the market can remain irrational longer than you can remain solvent. So there's no guarantee that discounts will narrow. The current discount premiums to NAV really purely to illustrate the sort of big range in the sector. So NB Private Equity standing there on the left-hand side on a 25% discount to JP Morgan Cazenove's estimated NAV. On the right-hand side, 3i Group on a 25% premium to NAV. And again, you can see Augmentum and Chrysalis, both of whom are sort of more early stage venture-y investments who make minority investments, are more flavor of the month than private equity, which I'm sure the managers will explain as a bit more of a sort of proven process through the cycle. And then considerations, just very briefly. Obviously, we've got plenty of research on our website, Kepler Trust Intelligence, for examining these in detail, but considerations for investors in listed private equity trusts. First of all, obviously, you can look at the different approaches each manager takes, direct versus fund of fund. Some trusts have sector focus, whereas others have more generalist or niche expertise. Commitment cover and leverage. Some of the trusts have leverage or have committed more capital than they have net assets, really to minimize the cash drag, and each trust has a different approach. Dividend yield, it's worth, some of the dividend yields that look quite attractive. It's worth being aware that this is capital being returned as income, and very few of them have running yields. And then the discount versus premium, but again, there's no guarantees that a discount might narrow, and it definitely shouldn't be a driving factor in anyone's investment. So I'm sure I'll give you a couple of seconds to read this obviously important information before I hand over to Paul Daggett from Neuberger Berman. Thank you, Paul.
Great. Thank you, Billy, and thank you, everybody, for spending the time to listen to the presentation today. So I'm going to tell you about MB Private Equity Partners. And if we move forward a couple of slides, then I'll first of all start off by giving you an introduction to Neuberger Berman, which is a large privately owned global asset management firm with over $400 billion of assets under management. MBPE is managed by the Private Markets Group of Neuberger Berman, which manages about $70 billion of private markets commitments, mostly for institutional investors such as public and private pension funds. We have over 150 people in the private equity team across 10 different offices, and we're a very well recognized private equity investor. The high profile we have within the private equity industry means we have deep relationships with many leading private equity funds globally, which is possible because of the breadth and scale of the platform. On the right-hand side, you can see that we believe MB Private Markets is a leader in responsible and sustainable investing. And both Neuberger Berman as a whole and MB Private Markets have been awarded A+ ratings by the PRI in their most recent ESG assessment. We have a dedicated ESG team, as well as integrating ESG factors into our investment due diligence. And in addition, MBP has a sustainability policy put in place by our board, and we work with our ESG team to implement and monitor that policy. Moving on to the next slide, and MBP itself. There's 5 points on this page, which really are the key attributes of considering an investment into MBP. You can see that, first of all, we leverage the strength of Neuberger's $70 billion private equity platform, which give us global resources and reach for the MBP fund. MBP is a direct fund, as Billy described, which primarily invests through equity co-investments, and the portfolio is weighted to the US, which is the largest PE market, and we believe offers a number of advantages. MBP's strategy is to invest through equity co-investments alongside high-quality private equity funds, and we have a highly selective approach in doing that. And finally, we have a strong track record of returns, and as you can see on the next slide, that's obviously a key part of what we see as the opportunity. If you look at the charts, we show both the US dollar NAV total return and the sterling NAV total return, as well as the share price total return, LTM, and over 1, 3, and 5 years. And you can see returns across all these metrics have been good across these periods. One important feature of private equity is that very often when a private equity-backed company is sold, there's often an uplift on the exit, which is a function of the underlying valuation policy and the illiquidity discount that is often factored in to private equity valuations relative to public market investments. And you can see in the box in the mid right of the table that over the past 3 years, the average uplift on an exit has been 21% for MBPE. So in other words, companies that were fully realized were on average sold for 21% more than where they were marked in MBPE's portfolio 3 quarters prior to those exits occurring. In addition, as Billy described, many listed private equity funds trade with a share price that's at a discount to the stated net asset value. And in MBPE's case, shares are currently trading at a 24% discount. If you compare that to a private equity secondary market transaction, which often occur at around par, occasionally sometimes above par, you can see one of the reasons we believe MBPE represents an attractive value proposition now with those 2 discounts in mind. And finally, and really importantly, the board and manager are very focused on narrowing this discount. In our opinion, MBPE's unique approach, performance and fee structure justify a far narrower discount, and we're actively working on a number of initiatives intended to help us do this. On slide 6, again, Billy covered a lot of this, but just wanted to really give the case for private equity. First of all, and most importantly, as you can see, returns over the long term have outperformed public markets, and in the case of first quartile private equity, significantly outperformed public markets over a 10-year period. Billy also mentioned active ownership. We believe a key structural advantage for private equity is exactly this. Managers can implement their own plans on a company because they completely own and control these companies. And of course, they do that away from the pressure of quarterly earnings reporting, which is necessary in public markets. Finally, there's also a very large number of target companies. You can see on the right, there's over 40,000 private equity owned companies globally, which is a growing number. And within this number, there's also a lot of different diversity of company types, sizes, approaches, and profiles, which can add diversification to an investment portfolio. Moving on to slide 7 and how to invest in private equity. Well, institutional investors typically invest in private equity through limited partnership investments. And in these funds, each investor commits to a 10+ year fund and pays a management fee, which is typically 1.5% to 2% of committed capital, and usually a 20% carried interest on gains. Of course, there's a $5 to $10 million minimum for these type of funds usually, and they are illiquid until the underlying assets are disposed of. So another way to invest in private equity is through a fund of funds, which is an approach where a manager invests in a number of these funds to give you a diversified portfolio of high quality GPs. And of course, the fund of fund manager itself charges a layer of fees and builds a highly diversified portfolio of underlying private equity companies. MBPE invests through a third approach, which is on the next slide, which is through equity co-investments. So an equity co-investment is a direct investment into a private equity deal alongside a lead sponsor. The value proposition is that the private equity fund can invest in a larger company than it might otherwise be able to without sharing control. And in return, the co-investor usually pays no management fee or carried interest to that lead private equity fund. To make this model work at scale requires a large private equity platform in terms of capital available for investment and team size and resources. In recent years, MD Private Equity has typically reviewed 350 or more co-investment opportunities per annum and invested in about 10 to 15% of opportunities we see across the platform. This means we can be very selective and carefully select what we believe are the best opportunities for MDPE's portfolio. On slide 9, this gives you an idea of who we invest alongside. So really, co-investment deal flow and quality starts with the partners that you have in private equity funds. And across MB's platform, we have over 500 active private equity fund relationships. This is the private equity business. This is not MBPE. But we have these relationships, and this generates typically, as I mentioned, 350 or more investment opportunities in co-investments that we see every year. We look for opportunities alongside high quality managers in their core areas of expertise. And to illustrate this, below you can see the logos of the managers we've invested alongside in MBPE over the past 3 years. Some of these will be immediately recognizable, like KKR, BC Partners, Silver Lake, but all of them are very high quality managers. For example, Thoma Bravo and Francisco Partners are 2 of the leading software and technology private equity funds, and other examples would be Pritzker and THL are 2 very high quality US mid-market managers. Our co-investment strategy means that MBPE has a manager diversification and is not dependent on any one of these GPs for future performance in the same way you would be with a single manager fund. And there are actually 52 private equity fund managers represented in our direct equity portfolio, which in total is 88 investments in that portfolio. So you can see there is very good manager diversification in the underlying portfolio. On slide 10, just to give you a bit more insight into the direct equity portfolio, which is 90% of the total portfolio and represents $1.2 billion of value. The portfolio is appropriately diversified, we believe, with 88 investments alongside those 52 general partners that you can see on the page in the middle. These positions we think are large enough to drive performance if they perform well. And you can see that when I talk about year-to-date performance so far this year. The top 40 investments represent almost 70% of the value. So you can see there is some concentration, but equally there's good diversification in the portfolio. And on the right-hand side, you can see 2 pie charts which look at the total portfolio. Overall, the portfolio is weighted to the US, as I mentioned at the beginning, but also well diversified by sector. But to really, I think, get a better view and understanding of our sector and thesis approach, if we look at the next slide, slide 11, you can see that over the last several years, the portfolio has been carefully positioned to be focused on one of 2 types of investments, both of which we expected to be well positioned for a late cycle environment, and what we believed could perform well through a downturn. And this actually positioned us very well for the events of 2020. First of all, also to note, in the same way Billy did, these are well-established, profitable businesses which can be improved, we believe, by private equity ownership and not in early-stage investments. The majority of the top 40 investments that you see on the page can be divided into one of two types. At the top of the page are companies which really the underlying investment thesis is around secular growth trends. So one example of what I mean by that is there are a number of companies which benefit in some way from the growth of e-commerce as more and more people shop online, whether that's the retailers such as PetSmart Chewy that is directly involved in e-commerce, or a company like AutoStore on the right-hand side of the top left box, which is a warehouse automation business, again, a derivative exposure to that e-commerce secular growth theme. There's also industries with low expected cyclicality, which are towards the bottom of the page. And these are investments where we think that with private equity value add, we can drive significant value, but equally because they're in sectors which we expect to be relatively low cyclicality, like, for example, USI, which is an insurance broker in the US, or Telexius and Ivory, which are telecom infrastructure businesses, we expect them to be more stable in their performance through a downturn. But as I mentioned, hopefully with that private equity value add driving performance through cycles. We believe these businesses with these characteristics can offer reasonable downside mitigation, but still offer strong long-term growth opportunities. And this positioning really is a result of careful portfolio construction over several years, selecting what we think are appropriate opportunities from the large deal flow of the NB platform. And this is one of the advantages of a co-investment strategy. We choose the individual opportunities and the timing. On slide 12, I just wanted to give a quick case study, which we think gives a good idea of the private equity value add, as well as the type of company we have in our portfolio. So BCA was a take-private investment completed in 2019 by TDR, which is a very high-quality UK and European mid-market buyout manager. The company has since been renamed, and Constellation is the largest vertically integrated digital used car marketplace in Europe, trading over 1.5 million vehicles a year with £12 million of total value annually. The investment thesis here was based on a unique and defensive business model of the company, but of course with the private equity value add from TDR. The benefit of private equity ownership was demonstrated in 2020 as the company was agile during the initial COVID market shock, quickly positioning it for the new normal. It quickly shifted from physical and digital auctions to being exclusively digital, and now is 100% of its remarketing of vehicles is online. Later in the year, the company again quickly moved to invest in a growth opportunity and diversify the business into business to consumer. Previously, it had been a business-to-business focused company for the most part. And they accelerated this with the launch of Cinch in October of 2020 that you can see at the bottom of the slide, which has quickly been established as the largest online B2C marketplace for used cars in the UK. The result is a company that's been transformed from a physical car auction business to a technology-driven B2B and B2C car marketplace. And we believe this is a good example of active private equity ownership and the resilience and opportunity that exists in MBP's portfolio. So moving on to the performance of the fund, you can see that over the last year, both the NAV total return and the gross portfolio IRR of direct equity investments are both just under 50%, which obviously has been extremely good performance over this time period, really since the low of the COVID market in the second quarter of last year. The performance has been based on underlying company performance, and you can see that there's been a 6.1% average earnings growth in the companies over that time period, as well as, of course, valuation increases in the companies, but importantly also through liquidity, which has been particularly important because of the uplift that I mentioned on exits, which over the last 3 years on average has been about 20% when those exits have been crystallized. Actually, in fact, 2021 was a record year 2020 was a record year for us in terms of liquidity, and that really has continued into 2021. And you can see on the next slide that so far this year, we've had 7 announced full or partial exits from the portfolio, as well as the IPO of one of our largest positions in Agility. In aggregate, these events have resulted in an 84% uplift from their valuations at year end, $145 million NAV gain based on where these marks are expected to be, as well as a 3.6 times multiple of NBPE's invested capital. Of note is that despite the large value appreciation, these transactions will produce only one of the 7 companies in this list was in the top 10 largest positions at year end, and that's the 7 partial exits. But additionally, Agility, which was the largest position in the portfolio as of year end, completed its IPO in April and has performed well in the public market since that time. So really, you can see 2020 was a good year. 2021 has started actually even better through the first 5 months of the year with these very significant liquidity events occurring. On the next slide, we do pay a regular dividend. We recognize how important a regular source of income is for many of our shareholders and have a long-term dividend policy of distributing at least 3% of net asset value. As you can see, the dividend has increased more than 40% since 2013, and the dividend was uninterrupted in 2020. In fact, the annualized dividend was covered more than 7 times by cash realizations from the portfolio during the year. So finally, just to summarize, we believe NBPE has a truly differentiated strategy relative to other listed private equity funds, in that we can be selective, we can be dynamic with our investment pacing, and we can be fee efficient through investing in co-investments. NBPE has produced very strong performance, as you can see, in 2020 and 2021, and we think maintains an attractive and well-positioned portfolio. The portfolio is fully invested, and in fact, it's actually 116% invested and has an average holding period of investments of 3.5 years. So we're hopeful that having a portfolio that's performing well, that has been held for a substantial period of time, and exit markets that certainly have been receptive in private equity, in trade buyers, and in public markets. We're hopeful that the portfolio remains well positioned for all those reasons. And finally, we have a strong investment pipeline. The MD platform is continuing to see very strong deal flow for new investments, and NBPE is positioned to selectively participate in this with over $300 million of available liquidity to invest in new companies as and when we choose to. So that concludes the presentation. I'll hand it back to Billy. Thank you.
Thank you so much, Paul. An impressive amount of information in almost exactly 20 minutes, so well done you. Alan, no pressure, but here you go. Thank you very much.
I'll try and be as prompt and as Paul was. So, good afternoon. If we can turn over the slide and give a brief introduction, I can sort of touch upon these 6 key points. So the first thing to say is that Standard Life Private Equity Trust is a kind of fund-of-fund strategy and has been over the 20 years it's been in existence. It was formed in 2001 and really focused in on picking the best funds in the European market over that time period. More recently, though, we've been moving into the direct space, and we can talk a little bit about that. But if we start from the top, this is a conviction play. It's not about being a private equity index. It is about picking what we believe to be the best managers, built from years of strong relationships and independent research. So we've 17 core managers in the portfolio, and our top 10 fund investments account for around 50% of NAV. So as I say, it isn't a sort of spray and pray strategy. At the same time, it's specialist. So over 20 years, we've focused in on the European mid-market, and that provides deep market intelligence, access, a long-term track record of performance. Our team has been investing in private equity, both in Europe and the US, since the 1990s. We've got over $12 billion in private equity alone. We've got scale with 40 investment professionals. So there is real strong specialist knowledge there. But whilst you get this conviction and specialism, we are diversified in the trust here. So we've got over 450 underlying portfolio companies, and very well balanced across geographic regions, sectors and vintages, and with an increasing focus on technology and healthcare, which we'll illustrate further later on. We're responsible investors. Aberdeen Standard has been very focused on ESG for a long, long time, and we're committed in SLEPI to only invest money alongside private equity managers that are either best in class in terms of ESG or are culturally committed to improve their ESG credentials. And as I alluded to earlier, we're increasingly direct. So 2 years ago, we included co-investments in our investment objective for the trust. In reality, we've been investing in co-investments over 20 years. We've had a dedicated co-investment team of 8 individuals for the last decade. It was a very logical evolution, and we're making good progress there. And if I touch on performance, it won't surprise you, it's been strong. Private equity performance over the last decade has been strong. SLEPI has performed strongly over 20 years through the global financial crisis, through the global pandemic, at 10.7 NAV total return over that period. Consistent year-on-year NAV growth since 2009, 13% annualized NAV total return over that period. And in 2020, the NAV total return was 22%, notwithstanding the global pandemic. And throughout the time periods, that's outperformance compared to the FTSE All-Share. So if we move quickly on, because I want to keep to time, let's take a step back and talk a little bit about private equity. And Billy and Paul have already touched upon this, but I'll try and layer on some more colour. I mean, it is favoured by institutional investors. You can see in the chart on the right-hand side that this survey by BlackRock indicated that institutional investors will increase their exposure to private equity and private debt at the expense of more traditional asset classes. But the problem we have in terms of individual investors around private equity, it's several-fold, and Paul and Billy have already touched upon this. It's hard to find in diligence. The minimum check size for private equity is very large. Often the best managers that drive the performance in private equity are oversubscribed. There's regulatory issues, there's complexity around tax, there's the illiquidity element of it, there's the valuation point around that being quarterly and not daily. So there's a lot of complexity attached to investing in this sector. If we move on another slide, it's just a reminder of the challenges that traditional asset classes have, and it'll be well known to you. So lower expected returns, converging correlations, shrinking market in terms of the number of listed companies, and concentration in the FANGs. So private equity can help sort of complement these traditional portfolios and mitigate some of these challenges. So if we move on another slide, it offers a ton of benefits that have been touched upon already, and you know, the stronger returns, as Paul alluded to, a growing opportunity set. Private equity is around 4 billion, sort of 4 trillion even AUM. There we are, and growing. Some estimates expect it to double over the next 5 years. It has a lower correlation with traditional asset classes, and also innovation. That's a key point. Technological innovation is being driven by private markets, and there's just a higher number of private companies to choose from on a global basis. So we move swiftly on, I think, to slide 8. Oh no, we'll skip. We'll go back to 7. Sorry, I forgot there was another last slide on the market here. So there's some perceptions here, and we're trying to dispel some of these myths. So, you know, it's an illiquid asset class. Yes, on a relative basis, but in reality, it has the same sort of liquidity as property or small cap stocks. The secondary market is quite efficient these days compared to 10 years ago. And SLEPI in particular has daily liquidity, as NBPE does. There is a lack of transparency. Again, we don't think this is the case. It allows for more transparency There are no insider restrictions. SLEPID is listed on the LSE and it's subject to strict disclosure rules. It's higher risk. Again, we think that it's similar sort of risk profile, really, where stock selection is key. And given public markets continue to shrink and become more concentrated, we think there's an opportunity for greater diversification there. And ESG is a big component of private equity these days, and the fact that private equity managers are typically majority owners gives them more influence and ability to scope this. And then poor performance, once these fees are deducted, again, I think MVPs and our performance and all the private equity trusts dispel this myth, and it's showing strong outperformance compared to public indices. So again, moving swiftly on to SLEPID more specifically, and we touched upon these points. I don't intend to go over them again. So let's move to 10. And slide 10, around our conviction here. So I mentioned this earlier, we're not an index. We've got over 80% of portfolio NAV to 17 core managers. And we think being very selective on who we partner with has led to superior returns. So actually, when you benchmark our picks over the last 10 years and since inception, over 70% of our picks on a money multiple and IRR basis are top or second quartile. If we move on to the next slide. Specialism, again, just reiterating this point, we have been focused on the European mid-market over 20 years, and you have this exposure to Europe. Over 80% of NAV is to European managers, over 85% of NAV is to European headquartered underlying businesses. So there is that sort of market intelligence, that long track record, the ability to access hard to access managers. But we also like to pair this with selective exposure to complementary strategies. So we have done more lower mid-market strategies in recent times. We still do access the best large cap managers that have graduated from the mid-market, the likes of Advent International and Permira. We're looking to go more specialist. We've backed technology specialists like HG, Vitruvian, Great Hill in recent times. And we do continue to make targeted US commitments in the mid-market space through the likes of, Great Hill, Seidler and M South. If we move to slide 12, this is just another way of illustrating this, with our core focus being on that mid-market space, fund sizes of around $1 billion to $3 billion, but the ability to be selective in lower mid-market and managers that have graduated to the bigger space, but increasingly making commitments to managers with a growth slant on top as well. So just to get access to some of the more technological innovation just that little bit earlier in the cycle, but where companies are really are cash break even. There's not venture capital. It's just about accessing things a little bit earlier in the evolution. On the next slide, you can just get a picture of the diversification of our portfolio. So we really like these slides because if you look at the geographic diversification, it's very well balanced. So the United Kingdom is our largest single country exposure. That's no surprise, given the UK is one of the largest private equity markets in Europe, and it's our home market. So there's that natural bias, I suppose. But you can see the Nordics close behind and France as well. So there's a good balance there. The maturity, again, this is a really interesting one, which kind of shows that just over 50% of our portfolio is to underlying companies that have been held for 4 years or more, that are ripe for being exited and sold to another buyer and driving distributions. But it's well balanced. You can see there's a good amount of new companies coming through, but mature companies in the portfolio as well. And then on slide 14, there's an illustration of our sector evolution. You can see in 2010 that technology and healthcare was a mere 14% of the portfolio. And September last year, it was almost 40%. And if you combine that with the consumer staples, these sort of more resilient sectors equated to over 50%, a little bit over 50% of NAV. And like NBPE, sort of this weighting towards these more resilient sectors has really helped our portfolio travel through the global pandemic. We estimate, as at the tail end of last year, that only 2 of our top 100 companies, which equates to over 60% of NAV, was materially disrupted by COVID. One was a restaurant business and one was a leisure business. So we think the vast majority of the portfolio, those 2 companies being less than 1% of NAV, by the way. So we feel like the vast majority of the portfolio is in a really good place. If we turn on to the next slide, this is just illustrating our focus on responsible investment. At Aberdeen Standard, we have a central ESG team that are there for us to use. We also have 2 individuals that form our specialist private markets ESG team, and again help us with our views. We're Aberdeen Standard is an A+ signatory of the PRI, and we do ESG due diligence now on everything that goes into SLEPID. And we'll only partner with managers that take this seriously. And we want to, over time, begin to report on the portfolio on ESG and sustainability KPIs. So that's a big challenge for us over the next 12 to 18 months in an industry where frankly, we're not that standardized in the way that we report. But there's certainly a lot of movement and a lot of momentum in this space. I think slide 16 kind of rounds off the strategy piece on direct investment. This is only introduced a couple of years ago. We've got 6 co-investments at last count in our portfolio. I think with the pipeline that we have, it's safe to say that this will continue to grow, and we hope aspirationally over the medium term that we can grow secondaries and co-investments to around 40% of our book. That's what we're looking to do. We feel having that balance between making fund commitments, which gives the GPs that that sort of that backing, shall we say, and it gives our trust the diversification. It leads to really good secondary and co-investment deal flow that we should be able to prosecute, and that obviously has advantages in terms of costs, as Paul alluded to, and then hopefully returns. So we hope that will be accretive overall in the medium term. Very quickly on performance on the coming slides. So this is some of the highlights. So you can see the 22% NAV total return to December. Our March numbers will be released later this month, around the 22nd of June. So we're hopeful that we'll be able to continue with the strong momentum we saw in the second half of last year. The share price has reacted pretty well over the period. Obviously, discounts dropped to above 50% in March last year due to the turbulence in the markets. It was a very good time to buy, that have closed in nicely since. We're sitting at around 846 million assets. So we're pretty pleased with how things are traveling at a high level. If we move on to the next slide, you can see sort of the recent investment activity logos of where we've been active. The top half gives you the sort of logos of the private equity managers that we backed. The bottom half is around the secondary and co-investment deal flow. And you can see the sort of co-investments we've been backing in recent times, the likes of Action, a discount retailer led by 3i in continental Europe, that we've backed through the fund over the last 10 years, but co-invested in, I think it was sort of last year, around the turn of 2020. Visma, the sponsor being HG Capital, mission critical SaaS in the Nordics and Benelux. NAMSA, led by a healthcare specialist called Archimed, which organization for medical technology. Funicap, funeral services business in France, and then a sort of a technology business led by Nordic Capital that we'll be able to reveal in forthcoming reporting. Just confidential for now, but it is a really exciting, fast-growing business. If we move on, recent cash flows have been phenomenal, actually. There's been a lot of strong exit activity, both on a full exit basis. There's some of the logos of the companies that exited in the past sort of 6 months or so. As Paul said, you know, we see a similar thing. You know, that average uplift upon exits above 20%, and you know, we're pretty pleased with performance there, particularly where we were back in March of last year, wondering, you know, where the distributions would come from during lockdowns. The market has responded really strongly, and we really like the fact that there's been a lot of IPOs in our business. The next slide, hopefully, if I remember correctly, should illustrate some of that. There's some of the IPOs in the recent past in our portfolio, and you see a good mix between, you know, software with TeamViewer, which has obviously benefited from remote working during lockdown periods and is listed on Frankfurt Stock Exchange. Moonpig, again, the sort of online gifting business in the UK earlier this year. Allegro, the sort of Polish equivalent to Amazon. Dr. Martens, which was listed in the UK this year. You know, and things like Nordnet and you know, Petco, InPost, the sort of e-commerce lockers business as well. There's been a lot of private equity companies listing businesses in recent times, and we've been a beneficiary of that, both in terms of cash back, but also valuation uplifts. On the next slide, just gives you a case study. So you're just relating to Dr. Martens. I mean, we backed Permira for many years. Permira made an investment into Dr. Martens, sort of slightly unloved sort of brand, footwear brand in the UK, and has completely transformed the business. And I think this is a great example of what private equity can do by helping them with their e-commerce strategy, with their go-to-market and sales strategies, in improving the business and professionalizing it, and then taking it to the stock exchange earlier this year, where they made around 16 times their money. I think it's a wonderful example of what private equity can do by being an active owner and transforming a traditional, long-standing brand. And likewise, on the next slide, you can see Moonpig, which again is one of our top 10 assets. Again, Exponent were able to buy this business, take majority ownership, and help a fast-growing business professionalize itself, build out the management team, and invest in the technology platform and the geographic expansion. And then again, list the business for around 6 times their money. So 2 really good examples of you know, the type of thing you can buy into when you invest in Slippit. I'm not sure how I'm doing for time, frankly, but if we move on, just to summarize, you know, the performance has been strong in 2020, and try and give you a bit of an outlook here for 2021. I mean, as mentioned before, 22% NAV total return to December 2020. Very happy with that, and that equates to almost 17% annualized NAV total return over the 5 prior years. Strong new investment activity with 3 co-investments during the year, 1 secondary transaction, and 7 funds, with ESG an integral part in all of those investment decisions. A highly resilient portfolio that hasn't been impacted by COVID in any strong way, with 98 of the top 100 largest companies only experiencing a limited or temporary impact from the pandemic, and that equates to over 60% of value, and good diversification across geography and sector, and maturity, which should give investors peace of mind when investing in this. And actually, I haven't mentioned this so far, but a very strong balance sheet. So we've got around 60 million of cash at present, 200 million undrawn RCF as well. Our overcommitment ratio is quite low, actually. We want to usually have an overcommitment ratio between 30 and 75%. It's low at sort of 24% at the moment. So, you know, very strong balance sheet, which should support the ability to have plenty of firepower to take advantage of investment opportunities over the coming months and years. So I don't know how I've done, Billy, whether that's 20 minutes or a little bit less, a little bit more, but I think that's all I wanted to cover.
Brilliant. Thank you, both Paul and Alan. I'm sure we could probably leave it on some key risks or disclaimers for people to read through. In the meantime, thank you very much for the questions we had so far. Had some good ones, which I've noted down. I'm trying to draw them together. If you've got any questions at all, please do put them in, and I'll try and get around to them. But obviously, both of you are picturing or painting a pretty rosy picture, and so again with the compliance team tapping on my shoulder, can you please describe what, obviously things don't always go right in private equity, and what's the typical course of action when investments don't go to plan, and obviously bearing in mind the fact that you can't just sell them and forget them as you can with a well, my own PA portfolio. If something's not gone wrong, you can just sell it and then you don't have to think about it. So Paul, why don't you go first, and then we can Alan can do another one.
Yeah, so it's a very good question, and ultimately, again, it comes back to the private equity model and the fact that a private equity fund is an owner of a company. Typically, the companies we're investing in, they own the majority, they control the board, and they can take any course of action that they see as necessary if things aren't going well. And so, obviously, it depends on the company, the industry, etc. But ultimately, it's about when we invest in a co-investment alongside a fund, part of our work is to review previous transactions that have gone well and those that haven't gone well, and really see exactly what they've done in the past and how they navigate out of those situations. So, usually it's about making the relevant changes, and of course, the one thing in favor for private equity in those kind of situations is time. That as an owner, you have time to do whatever you need to do with management, with strategy, potentially with add-ons, to correct for things that aren't going well. But ultimately, of course, not every investment goes well. And even with all of the things I mentioned, not everything will go well. But obviously, what you'll look to do in those situations is have a sponsor who tries to maximize the value of what they have in a company. So even in an investment that's been disappointing, you'll take it to the market and look to sell it either to another private equity fund who has an idea of how to, again, maximize value from the platform, or to a strategic. But ultimately, over time, you'll look to exit that position through that type of transaction.
Yeah, I would just echo that. And, having that majority control allows private equity managers to change up management and to make, changes that hopefully turn around that business. I know when we do due diligence on private equity managers, their ability and the portfolio of case studies that they have around turning around challenged businesses is certainly something that we look at. And then I would say, yeah, as an investor, from our perspective, we've sold many funds over slippage 20 years when we felt like the fund hasn't been doing well, when the manager hasn't been delivering to plan, and it might be a good time to sell in the secondary market. And secondary market has a ton of capital right now, and there's a lot of demand for private equity funds of all quality levels. So that's another way that we would deal with it.
So this disconnect between the popularity of private equity and the discounts, there's a few sort of interrelated questions, but why, given that other investment trusts manage their discounts through buying back shares, is that not an option for some of the listed private equity trusts? Is there, what would you see as the most effective method of reducing the discount, and why is private equity, in inverted commas, unloved by retail investors, if not institutional investors? Have you guys got any comments on that? Paul first. I mean, I suppose
there's a lot of questions there. but I have thoughts on all of them. I'll try not to take too long. But first of all, as you say, Billy, there is a big difference between the institutional private equity market and the listed fund market. And again, the example I used was in the secondary market, trades of funds in between institutional investors very often does happen close to par, sometimes above, sometimes below, but very often close to par. So that gives you an idea of where the institutional market trades good private equity assets. In terms of the listed fund market, I think it's there's a number of things. First of all, there is a relatively small market for buyers. I think I think that's part of all of our jobs in listed funds is to really make known what we're doing and the returns we historically have been able to generate, and obviously try to increase the overall market size. I think that there's various organizations and events like this which really are designed to show that to investors that there is this opportunity and to work together to increase the overall market size. But other things that we can do, certainly marketing, and we're working on a number of things internally around that. In terms of buybacks, yes, it is an option to MBPE and other listed funds. For us, it's obviously not a manager decision. That's entirely a board decision. And over time, we have bought back shares at certain points in time. And the board is always, looking at what the right use of capital is, whether it is share buybacks, first of all for the return, and secondly to try to voice the support for the shares. But of course, capital is limited, and there's other uses for it. And of course, also by buying back shares, you are actually reducing over the long term the potential liquidity of the fund. So there's a lot to think about, and that's a board decision, but it is an option to listed funds. So I'll let Alan chip in. I'm sure he has lots of ideas as well.
Yeah, I mean, it continues to mystify me, to be honest, the discount, if I'm frank about it. I mean, buybacks are an option, but our view is they don't tend to be that effective. It maybe gives you a short-term effect, but you tend to be back where you started. I think the most effective way is sort of trying to get out there in markets in an effective way that allows you to dispel some of these myths that I think were created around the time of the global financial crisis, when some private equity trusts didn't perform as well. But I think you can see this current cohort in terms of performance, in terms of balance sheet. I think we should be shouting more about the successes of the industry. I noted the other week about Invest Europe's piece of work around the growth in employment in private equity-backed companies. So private equity created on a net basis of over 250,000 new jobs in 2019, which I thought was really interesting, and I think that would be contrary to a lot of people's preconceptions. Whether it's unloved by retail investors, I'm not sure. I mean, the marginal buyer in terms of SLEPID has been retail investors. I think it's other categories that have their own reasons for focusing in on the costs. I think that they just can't get past the fees. It's an expensive industry. We have to be honest about that. But I would really encourage people to look at the net returns. The net returns have been very strong.
And just maybe quickly to build on that point that Alan made, the slide that Billy showed at the beginning that showed the universe of London listed funds, most of these have got very good track records, and most of them trade on discounts, obviously varying levels of discounts. But I think first of all, if you look at MB private equities share price growth over time, it's been good, as I pointed out. And that's obviously despite the discount that has varied over time. So of course, that's a risk of listed private equity, that the discount can move around. But obviously, our first priority is, I'm sure this is true for all of us, is to make sure that the NAV growth is good. And then, of course, we have to work at all of the things we're talking about to try to minimize the discount over time. And the more we can do that, obviously, the better we can produce good share price performance. And I think I can certainly speak for us and say that's something that our board is extremely focused on, is the discount level at the moment and what we can do about this exact issue.
A sharp-eyed investor has seen you've both got Action, which I think is led by 3i. I wonder, did you both invest at the same time, or?
I don't know when Paul initially invested. I mean, I'll give you our story. I mean, we backed 3i's fund, Euro Fund 5, I think in 2008. I say we, the royal we. I wasn't in the team then. And then they invested in Action initially, I think in 2010 or thereabouts, and it was a real runaway success for 3i's fund. I think it was around 30 times cost that they cashed out at. We were quite a large investor in that fund. We bought secondaries in that fund, which were the best secondaries that Slepper has ever done. I think it was 4 times our money on that secondary of the fund. And then, yeah, obviously, because we're such a large investor and on the advisory board, we got offered the opportunity to co-invest in Action when they did that transaction. It's sort of, from memory, tail end of 2019, start of 2020, and you know, we're very pleased to continue backing that. We did full due diligence again from a co-investment standpoint, re-underwrote the whole thing, and so far, touch wood, it's going well and defying logic, given it's a physical retailer and still growing through the pandemic, which is fantastic.
And actually, our story is very similar. We, in this case, being the platform, not MBPE, was an investor in that fund, and we came in at the same time with a large co-investment across our platform. So again, in this case, based on the fund relationship. And much like Alan, I'll echo that we're very glad we did. It's you know, through a turbulent year for the markets it operates in, it performed very well, as you can see, because obviously 3i gives pretty detailed reporting on the company, but it's doing well, and you know, it looks like it has future growth prospects that are very attractive.
Great, thank you. I think we've got probably time for one more. A sort of common question is that we get, and which I'm sure but we'll give Alan the first go this time. The weight of cash and the firepower in the private equity industry. Do you see that as a sort of a threat and reducing future returns, and is the same thing being applied to, you know, investments that also display good ESG characteristics that are obviously private as well?
By that question, does it mean the dry powder in the industry?
Exactly, dry powder is how you guys talk about it, but yeah.
Very technical term, but I mean, I think it is. I mean, there's no getting away from it. There's been a lot of money traveling towards private equity because of the returns it's generated, because of the reasons that we've all outlined earlier in this call. That's why I think more than ever you have to back managers that are specialists, that can add value over and above management's plan, and really create value in that context. There is obviously the argument that more and more companies are staying private for longer, which helps mitigate this. But yeah, I mean, we're not counting on private equity delivering, you know, quite the exceptional returns of the very recent past going forward. If you look at some of the sectors like healthcare and tech, where private equity has flourished, I mean, pricing is really high these days. But we have no doubt that the private equity will continue to deliver returns, you know, much higher than public equities. That would be my view, you know, over the long term. I don't know what Paul's is. I suppose it'll be somewhat similar, but yeah, that would be my response.
Yeah, no, I think the short answer is, of course, it's as in any asset class, as more money comes in, it's a challenge. But again, it comes down to investing in or alongside the best managers who are able to actually implement value add to a company. And that's the advantage private equity has, that it can have a plan, whether it's M&A or whether it's organic growth or changing management or whatever it might be. There'll be a detailed plan to build growth in that company that justifies the entry valuation, and means that despite the competitive market, private equity, the best private equity, can still produce very good returns going forward. That's our belief. But it's active ownership is really, I think, the answer to the competition. And over time, of course, that means market returns as a whole might come down, but we still think that there are managers who have structural advantages and track records in certain sectors, etc. That can mean they can continue to produce very good returns on a go-forward basis too.
That's great. Thank you, Paul. Thank you, Alan. But most especially, thank you all those who've dialed in. I hope we'll have this recorded somewhere. So if you want to see this another time, maybe we'll be able to make that available. But thank you once again, Paul and Alan. It's been great, and hopefully we've answered many of your questions, and therefore we can accurately describe this as being a masterclass. Certainly, your performance in keeping time is definitely a masterclass in presentation. So, thank you both very much indeed. Thank you so much again.
Thank you.